Gold in Aussie dollars sitting on the all-time high as bank contagion spreads. Was Silicon Valley Bank the canary in the mine? Hi, everyone, and welcome to another week of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, Alex is with us to discuss everything contagion as we come out of a chaotic weekend of uncertainty for the markets, with more volatility expected tonight as we move into the US trading session. How are you going, Alex?
I'm going well. How are you going today?
Very good. I know I woke up this morning and it was chaotic. It's been chaotic all weekend watching things, but woke up this morning and read a headline that Janet Yellen was saying we're not bailing out the banks, and then an hour later or something we're bailing out the banks, or different terminology, but it's all over the place. So let's start by what's going on. Who are we talking about here, and who is Silicon Valley Bank? Why did they collapse? Give us that big picture overview.
All right. So Silicon Valley Bank is basically the bank in Silicon Valley that is lending and holding deposits for VCs, a lot of startups. They had last year in 2018, they had $50 billion in deposits.
Mm-hmm.
But as obviously the liquidity came into the market and your tech stocks boomed and your VCs had extra money to pump into these companies, their deposit base went from 50 billion to 200 billion by the beginning of 2022. And then what has happened, as we've seen recently, is in the NASDAQ dropped 36% last year. People can't raise capital as much anymore. So the deposits held by this bank went from 200 billion to 173 billion at the end of December, which doesn't sound enormous, but clearly these tech companies and the VCs are eating into their capital to support research and development. As we know, a lot of these unicorn companies are not profitable for years. So they've been drawing down on this debt, unable to raise money in a falling market. And then they're paying debt off at a higher rate. So that is what the Silicon Valley was. So it becomes a higher risk bank in terms of who it's lending to. But if you actually look at the bank itself, it was not a high-risk bank. It had $173 billion in deposits, and I'm going to look this one up, $73 billion in loans. So it had money.
Well and truly over-collateralized.
Well and truly over-collateralized. And most banks can, fractionalize, marginalize that sort of lending and take the 173 and lend it 3 times over. These guys actually hadn't even lent the full amount of money that they had. So
and there was a couple of anomalies with that bank as well, just because of the nature of it, as you've explained. It's dealing with startups. So I think the number was something in the order of over 90% of their depositors actually held more than $250,000 in their account, which is the amount that is insured by the FDIC in the US. So these are depositors who had big balances there, didn't they?
They did, but at the end of the day, so on Thursday when this all started to happen, which is, Twitter was on fire with this bank's about to collapse. Everyone ran for their money. So there was $42 billion that was tried to withdraw on between Thursday and Friday. Now, if you don't have liquidity in front of you, and liquidity in bonds, you can quickly sell bonds, but unfortunately, they had to do it at a loss because interest rates have gone from 0% to 4.75%. The fact that they had long held debt or long debt meant that they were discounting it.
And why did they hold that debt? Is that because the rates have been so low for so long, they had to sort of move further out in time and get sort of longer dated bonds to actually get a yield at all?
But most banks do have those long,
right.
Most of these banks are holding it. It's not unusual. What is unusual is the pace at which the withdrawals happened. And that would be industry specific. But, this contagion, as it's going to spread, and look at the real estate industry, it is following the NASDAQ down, I guess. You've got the NASDAQ going down faster because of how much liquidity went into it. But the same thing happened in real estate, but it'll be a slower liquidity squeeze to what we've seen in the NASDAQ. But what they were actually saying on Friday is that if they had left this bank alone, 98% of deposits would have been returned. It was
Yeah,
never a
right.
contagion. It was never really an issue. What has caused this contagion now is that you've got Yellen basically over the weekend saying we're not guaranteeing deposits. She didn't even need to say it. All the
Yeah.
deposits were there. It was just not an issue. And in fact, if they'd solved that debt, so if that contagion hadn't happened on Thursday with people trying to withdraw their money, by Monday, the T-note had dropped so much that they wouldn't have lost the money. Like, the whole thing is just poor management and a bank run that has now made everyone else look at what's going on in the banking sector in America.
And that's a really important point. So the contagion aspect of this is really about what potentially happens later tonight, even, isn't it? Where you've gone from people who might not have even understood what was going on. Let's be honest. Like, they might not have understood what sort of bonds were sitting on their bank's balance sheet. I mean, we all have our money in a bank and we don't necessarily go and look up what the bank is holding the collateral in. We just make a lot of assumptions. But I bet you today there's a lot of people all around the world, but particularly in the US with those in those smaller banks going, hang on, I might look that up. And they're probably going to find similar situations, aren't they?
They're not different. So the rules around the debt is, you do not need to disclose the losses, because if you carry it to maturity, you don't have losses.
Yeah.
It's right now, if they were to sell these bonds that are, say, 10 years out, they've gone from 0 to 4%. So say that they've dropped 4% in price, the bonds. If they sell it, they need to recognize the losses, but on their balance sheets, they don't. So they're trying to match, I guess, their deposits and their incomes to long debt, which works really well when not only are interest rates going down, but people don't need money. But people all of a sudden need money to service these crazy interest rate rises.
Yes.
And they're not huge interest rate rises, but they're so fast. They're so fast. We're on 10 interest rate rises in 12 months. That pace that's happened is what's causing this. And, we talk about in Australia how consumers bear the brunt of these interest rate rises through mortgages. Well, we've also spoken about how businesses in America bear most of that brunt, and the mechanism in America is businesses. And to date, we hadn't seen much from it. But today we saw, over the weekend, we've seen all of that, and now that is going to spread like contagion as people reevaluate the risk. Look at the banks. We in the article today, Bank of America was one that was looked at. Well, their market equity is $240 billion, and they've got $120 billion of mark-to-market losses if there was a run on that bank.
If they had to sell. Yes, exactly.
They had to sell, which normally they wouldn't, but there's an escalation in the pace that people need to take money out to service debt. So, I would say that there's a big mismatch in the way that banks have priced their long debt.
So that leads us to really the biggest question of all. Where does the Fed go from here? Because you've highlighted the issue, right? Like, now the market, we've known this issue for a while, but now the market is saying, this is the issue. We're actually experiencing it in real time. It's not theoretical anymore. We just have experienced it, and we're potentially about to experience a lot more of it. What do they do?
Well, I mean, they were pricing in 50 and 50. And I would say if they put anything through this rate rise, it's just going to cause panic. I mean, Bank of America, I think, has 620 billion odd in these long bonded debts. You raise it another 25, well, that might drop the bonds another 0.25%. What does it, that's another $30-40 billion off their balance sheet. There's not the capacity there now that the risk is being looked at.
Yeah. And that's the key, isn't it? Because there might have been the capacity just, 4 days ago, before the weekend, because people weren't looking. But when they're looking, they're going, hang on a second, this is the reality. This is where the rubber hits the road on this. And they go, we're not prepared to take take on that risk? I know that's something I was thinking about, and I mentioned to you when we were just discussing before off camera. Like you think about the capacity of these banks. Like some of the assumption is that, oh, well, these smaller banks will just get gobbled up by the big banks. But the big bank gobbling them up then takes on that additional long dated debt onto their books. And they'll be going, well, hang on, no, maybe we don't want to do that because we're already loaded up as well, as you've just identified.
Yeah, not only the long dated debts, but they've now got to raise equity in a falling market, because really their equity's got to be priced down now, because you've got the debt. Every time there's an interest rate rise, that debt risk is going to be very apparent now, and it's going to be much harder to raise equity. Honestly, it was a safe bank, and they did not manage their risk well, and they could have hedged against interest rates. They didn't, but by doing what by saying what Yellen said over the weekend, it has caused panic, and people have repriced this risk, and you cannot unprice this risk.
Yes, and we'll probably see, even though, like you just said, we've got a bank that wasn't necessarily in bad shape, maybe made some poor decisions, but that's probably the case with so many of these banks that, will each have their specific situation, but everyone's probably made mistakes somewhere in that will then all of a sudden come to light as people start paying attention.
Yeah, and I mean, everyone's talking about these smaller regional banks in America being a problem. This was the 16th biggest bank in America. It was not small.
That's not small.
I mean, they really, they're trying to now, I think, talk about this bank as high risk because it was a Silicon Valley bank. It wasn't. They all know it wasn't.
It had survived. I heard that this morning as well. It had survived the financial crisis. It had survived COVID. Like, it has survived everything. So historically, they've proven themselves.
Yeah, it was just the rate at which the deposits were being withdrawn because of the industry they were in. But people now need to look at those other industries where you've got similar falling asset prices and actually think, could this happen somewhere else? Like the real estate sector right now in the US is going to be the next sector that everybody puts a magnifying glass over, because they will have a slower risk, but the same risk.
Lots to pay attention to tonight and this week, I dare say. Well, Alex, thanks again for your analysis today, keeping your finger on the pulse as it rapidly evolves, this situation. We really appreciate that, and we'll be looking forward to hearing more from you about this. So thank you.
Well, thanks for having me again.
Thanks also, everyone, for watching. Remember, reach out if you have any questions or comments on the social platforms. We'll get back to you as soon as we can. That's us for today. Stay safe in the markets, everyone, and we'll watch what unfolds next. We'll be back again to talk later in the week. See you later.